All right, good Thursday afternoon, investors, traders, Finom Group members. If it's Thursday and if it's the state of the market, you know the deal. It's usually a down day, but not this Thursday, at least thus far. We've got a really robust rally on our hands, folks. 44.37, as you can see right there on the S&P 500. The Dow is up 540 points. The Nasdaq is actually leading the way. Today up almost 1.8, 1.9% on the day. So where did this rally all of a sudden come from? Well, it came from all the work that we generally do below the surface of the market, right? The deep dive analytics, the breadth analysis, looking at whether or not there's relative strength underneath the surface of the price action. So this week's aptly titled Below the Surface. Yeah, every now and then I have something, decent intelligence to say, I think. So here's mine for this week. Usually I look outward, out beyond my own, feelings and sentiment when it comes to investing, trading, and general touch points with the market. But this was something in my heart, on my mind. So here it goes. Patient, tactical, resourced, and disciplined investors are always rewarded. Manage those characteristics and you will massage your returns higher. Sound right? Yeah. Massage them higher. You've heard that before. All right. Now, the overall sentiment of the market has improved. It has improved. It was pretty lousy, back in September, even the first week. Although the first week we did have a gain in the S&P 500 for the first week of October, but it was very modest, and we still had some doubters. I would say even after today's rally, we still will have some doubters. But this is the sentiment trader panic euphoria model. And it was way up here in panic territory, folks. Coming off of that peak, but it's still elevated. It's still elevated. One of the most discouraging things that we've seen over the last 6 weeks, going all the way back to September and up to recently, is all rallies, intraday rallies. They just fall off a cliff in the afternoon. Wall Street generally gets back from lunch and behind the desk, if you will, and sending out those afternoon orders around 1:30. And what we've seen in the afternoon is just the market sells off. It might have a nice gain in the morning hours, but in the afternoon, and especially the final hour of the trading day, the sellers just come out in mass. And that's what this chart basically shows us here. The S&P 500 last hour performance since the start of September. Only 2 positive last hours in the last 10 trading days. Going back to 9/28, only 2 gains in the final hours. Last time we had a gain, well, actually this is, most of my notes here for the state of the market were compiled yesterday. It just so happened to be that yesterday we did have a rally in the final hour of the trading day, but in a pattern that's becoming all too familiar these days. The S&P 500 trades higher throughout the day only to give up those gains heading into the closing bell and finishing pretty much at the lows of the day. We've actually done that twice this week, finishing at the lows of the day. The trend has been even more pronounced over the last 2 weeks, as there have only been 2 trading days in the last 10 that the S&P 500 closed higher. Now, during this streak also, the SPDR, or the S&P 500 Index ETF, is closing in the bottom 25% of its intraday range for the 4th day in a row. This goes back to Tuesday when I compiled this data from Bespoke Investment. So the SPDR closing in the lower 25% of its intraday trading range for 4 days in a row. This has happened before. 14 of the 16 other 4-day streaks bounced over the next week. And maybe that is what happened as of Wednesday, where we did rally into the through the final hour of trading. So keep that in mind. These kinds of streaks where you finish that low on the day usually find strength going forward. All right, some seasonality. Now we know already that October is a pretty choppy month. You can see a lot of the squiggles here, and all of these lines represent the individual indices: the Dow, the S&P, the Nasdaq, the Russell 1000, and the Russell 2000. And over the last 21 years, the full month of October has been a solid month for the market. But these gains have come with volatile trading, most notably during the early days of the month. October has opened softly. As you can see here, the first couple days we're going down. And then we rally. And then we go down again into the 7th day. And usually that's where we trough. And we pretty much trend higher through the rest of the month. Not in a straight line, as you can see, but higher nonetheless. On the second day, all 5 indexes have been weak, followed by a rebound on the third trading day. The third trading day rebounds. Third trading before additional weakness pulls the index, pulls the market lower through the 7th trading day right here. Now, this is October 14th. October 14th is the 10th trading day of this October calendar year. So here we are, the 10th day. We should be higher than where we were here. We should be higher than where we were here on the 10th day. And indeed we are. We are. We've been in the 4,300 range in the S&P 500 since the beginning of October. Today, as of right now, as of this recording, we are 44.37, we'll call it, pretty much the highs of the session. Well, high of the session, 44.42. So the seasonality is coming to fruition here, folks. So far, so good. Why do we look at seasonality? One of the reasons we study seasonal patterns is because human behavior is rather constant in the markets. It may not be perfect, but it's pretty constant, repeated, or it rhymes. This chart right here represents that it's been 28 trading days since we hit a new high on the S&P 500. 28 trading days ago, September 2nd. Now, the last time we went this long without making a new all-time high, guess when that was? Same time last year. The new highs in 2020 took place on September 2nd of 2020. The all-time high in 2021 happened, that's right, on September 2nd. And again, this is why we study seasonal patterns. Yes, they're not always as perfect as this, but what this also informs us is that what's taking place is largely seasonal. It's not something out of the blue. There's not a black swan. This is just normal and to be expected seasonal headwinds that began in the early fall and have persisted to this point in the seasonal calendar. The good news is most of that seasonal headwind is in the rearview mirror. Usually it's an uphill climb from here through the end of the year. Again, not in a straight line, but uphill nonetheless if we're only focusing on the seasonal tendencies. 2020, all-time high, September 2nd. 28 days, we still didn't make a new all-time high. Here we are this year, September 2nd, again the all-time high. We still have not yet recaptured a new all-time high. It may be just ahead, but that's why we go through all the charts. This week, we're going to focus a lot on the charts. You're going to see a lot of charts here, not so many quantitative studies. Kind of ease through this week's SOTM. Don't worry, we'll have a lot for the weekly research report, I'm sure. So recall that this chart here, the S&P 500, and in the lower panel is the 14-day RSI. We looked at this in our September 23rd State of the Market. Over the last 4 years, when the S&P 500 has gone sub 40 on the RSI reading, it almost always had some kind of retest. So this is, again, going back 4 years, looking at the RSI. When we get below 40 on the RSI, we have a swoon in the market, we almost always retest. Here, dip in the market, here sub 40 RSI, and retest. Happened here, sub 40, retest. This, of course, it's its own beast. This is the pandemic. Here again, sub 40, dip in the market, rally, sub 40, retest. It doesn't have to be a double bottom exactly, but it's a retest of the area that the former low was made. And we did it again. We dropped below 40 back in mid-September, and with the market dropping, and then we retested with a new low this time. The RSI got below 40, and the new consolidation period low is 42.78 on an intraday basis. So this pattern has held very well, understanding the relative strength of the market and its tendencies. Now this chart right here, this is another way of looking at the S&P 500, its RSI, but using a moving average of the RSI, the relative strength index. So we're taking it, we're kind of smoothing it out. We're using a 15-day moving average of the relative strength index for the S&P 500. This has been a good buy signal over the last 5 years. So when the RSI gets to about down to these levels here, go back 5 years, it gets down here, you should have bought. Gets down here, of course, this is the correction low, you should have bought. Get down to these levels, pretty much 40 on the moving average is about 44 or so. This is a buy signal. Market bounced here, had your retest and bounced again and kept making new highs. Here we are again, hitting this moving average. If you had bought, market went higher, came back down on the moving average, market kept climbing. Here we were this year, I'm sorry, that's 2020. Market dips, you've got the moving average for the RSI dipping down here. If you had bought, you would have been in good shape, and it happened again recently. This is as of yesterday, I compiled this chart here. If you had bought when the 15 period moving average was hit by the RSI, you would have been rewarded with higher prices at the index level going forward. Again, this is its own beast and why it went that much lower. You don't buy all at once, of course. All right, this is another, we're doing a lot of RSI analysis. We've been doing a lot of that lately. One thing that makes this current decline steeper or found with lesser strength is in fact that the RSI had recently troughed below 35. Kind of looking back at last year's September versus this year's September, this decline was found weaker than last year's. Here we are in September last year, that was the swoon there. Here's the RSI at the bottom. It didn't quite get all the way down to this threshold here, which is 35 RSI. This time we actually dropped below 40 and below 35 RSI. during this September swoon. So this September swoon was actually weaker than last September swoon. Having said that, I'm of the opinion the recent weakness is likely forming a bottom in relative strength and potentially a bottom in the S&P 500 consolidation period. Of course, we won't know without hindsight, but so far all of the breadth and relative strength that we're looking at, these indicators that we're analyzing, they have all the trappings of a bottoming process that would, if it's not a bottom, it would take something from the fundamental side of the equation to exonerate. And we are in earnings season, so that is a decent probability. But usually these kind of breadth indicators are already taking into account at least a certain magnitude of those fundamental possibilities. All right, here's another way of looking at S&P 500 top panel. The NYSE stocks above the 200-day moving average are in the bottom panel. Again, this is a cyclical bull market. This is a new cyclical bull market. So when we're looking at these indicators, when we're analyzing breadth, we should approach our analysis through the lens of a new cyclical bull market. This chart analysis is originally from Oppenheimer's Ari Wald. He believes that the S&P 500 is bottoming, given the percent of stocks in the NYSE trading above their long-term 200-day, reaching a cyclical bull market trough point at the 50% level. And it's actually bouncing off of that recently. Again, in the past, cyclical bull markets, we usually trough at these levels. 2015, that was like an 18% correction in the market. A little less than a cyclical bull, but it was a cyclical bull. Here again, we trough in 2016, 50% of stocks trading above their 200-day moving average in the NYSE. That was the trough point again in 2016, trough point again in 2017. We had a big correction in 2018. This was a cyclical bear market here, technical bear market. We dropped peak to trough 20% intraday. We just never closed with a 20% decline. 2019, these are usually buying opportunities where you hit these levels and we're there again. So indeed, if in a cyclical bull market, which I believe we are, this is where you start buying. At the very least, where you start layering into positions. All right, so now that we've started talking about the NYSE, these are our notes from our weekly research report just last weekend, where we were looking at market breadth. This is the Mclellan Summation Index, which basically summarizes the Mcclellan Oscillator. And the Mcclellan Oscillator is an advanced decline line ratio index reading. And what we saw here was that we were basically in negative territory, right? And that's not good. It basically tells you, the broad market breadth is washed out. You have had corrections. It's just the index hasn't corrected fully. But most stocks have corrected, are still correcting. Some are even in a bear market. And in order for this to be in negative territory, the summation index in negative territory, it's the broad NYSE in negative territory. Most stocks have corrected, folks. So that's what we outlined in our weekly research report with this chart right here, identifying the New York Stock Exchange advanced decline line, which basically stalled out. It seems to have put in its lower lows, its lower highs, and might be starting a new uptrend. We would confirm it if we got above this level. Ultimately, you want to get a new all-time high in the NYSE advanced decline line. Now, also wanted to look back further, right? Because this is just a one-year chart of the summation index, so we wanted to look out further. And indeed, There's the summation index going back 5 years. And in the past, cyclical bull markets, you usually, when we come to this line, in and around this line, it's a buying opportunity. Most stocks have corrected. This is usually where it troughs. It troughed in early 2018. This was a cyclical bear market. We all know what happened here. This is the pandemic once again. Cyclical bull market, cyclical bull market, cyclical bull market. You want to start buying here. The other point of emphasis we made in our weekly research report with the summation index is, while this was a more local low here, back in July or August timeframe on the NYSI, and you made the ultimate low here on the RSI for the summation index, we made a lower low thereafter, but look at the RSI, it actually trended higher. So what we have is a bullish divergence here. We actually have relative strength, meaning that the NYSI was having more difficulty going down because we were building strength. So we made a lower low, but we did not make a lower low with the RSI. That was one of the signs that things were shifting underneath the surface of the market. And again, this is the broad NYSE. Fast forward to yesterday. And here again is a look at the NYSE advanced decline line. While the S&P 500 is basically still in its downtrend, the advanced decline line for the NYSE is sloping higher. Beneath the surface, more stocks are advancing than are declining. You have, again, a bullish divergence here. All right, what about the Nasdaq? We've talked a lot about the Nasdaq last week, but kind of update, see where we are here now. As of just a couple of days ago, if you will, on the 12th, this is from Sentiment Trader. Tech earnings season is just around the corner, folks, and FanMag earnings will kick off with Netflix early next week. Options traders are betting on tech trouble. The aggregated put-call ratio, which is this bottom graph here, in the top you have the Nasdaq index, bottom graph is the aggregated put-call ratio amongst Nasdaq 100 members, which is the highest, right? It's all the way up here. It's the highest it's been in over a year. The aggregated put-call ratio is the highest it's been in over a year for the Nasdaq 100. Now, if you pay close attention, when it was this high, back in November 20, that marked the bottom. May of this year, that marked the bottom of this pullback. And now, here you are. Could this be the bottom of the Nasdaq pullback, Nasdaq 100? Sometimes the fuel for the upside are downside bets against the index. It looks like it's shaping up that way again. This is just one trading day, folks, but this is a very powerful rally that has been undertaken here today. You have a lot of people that are offsides. They're positioned in contrary to today's move. I would be willing to offer today's move is not being generated by outstanding buying pressure. It's a lot of short covering. It's a lot of short covering. Follow through would help. If we get a continuation of today's rally into Friday's market session, which is also monthly options expiration, that would be more considerable. All right, recall we did this study from last week. This study was from last week. The percentage of NASDAQ stocks trading down over a 20-day period reached 84%. That was as of the past Monday. The 20-day forward returns over the past 10 years, we've had 20 occurrences, the average return was 5.25% over the next 20 days when you've had this many NASDAQ stocks trading at 20-day lows. The percent positive rate equals 90%. Again, this was as of last Monday. Fast forward to this week, the Nasdaq indeed is higher. It's up about 3% from last Monday. Market moves fast. Or actually, let's see. Here was Monday on 10-4. Nice red candle there. Indeed, we are higher. We're 2% higher than where we were. But that was before the open of today. So I would say 3% plus at this point. Now, the Nasdaq has work to do still. The RSI coming into today's trading session was just 44, and the index was below its 50-day moving average, which comes in at 15,159. Let's see where we are right now. 14,822. Nasdaq up 1.72% on the day so far. Still have an hour to go. All right, here's a new study. Again, Nasdaq is in the top. The percentage of Nasdaq stocks above their 100-day moving average. Kind of keeping it simple here, folks. How many stocks in the Nasdaq above the 50-day moving average? This is the Nasdaq 100 I'm speaking of, by the way. In the context of a cyclical bull market, again, this has been an area where investors usually step in and buy the dip. We had just less than 40% of Nasdaq 100 stocks above their 100-day moving average, under 40%. Going back to 2017, so going back 5 years, the signal offers that the following 20-day period, or over the next 20 days, the return is 2.19%. The Nasdaq 100 is positive 71% of the time. It's a pretty strong signal. All right, this chart here, again, looking at Nasdaq breadth. This is the Nasdaq Composite this time. The Nasdaq 50-day moving average relative to the 200-day moving average. When you get down to these levels, folks, right? You get down to these levels, these are usually buying opportunities. Got down here, the relative performance of the stocks trading above their 50-day moving average in the Nasdaq to the 200-day moving average, right? So that's the interim trend over the long-term trend. The interim moving average over the long-term moving average. When the interim trend weakens and gets down to this level here, it's usually a buying opportunity. Got down here, trough in the Nasdaq, rise. Get down here again, kind of a trough here, rise, rise, rise. We know this deal. Get down here again, trough in the Nasdaq, rise, rise, rise to the next zone. And this is where we were as of this morning. This is usually, again, this is a NASDAQ. We started, are we getting to a bottom? We discussed all this last week. All right, this is the NAMO. So we talked, about the NYSE Summation Index and how it basically compiles the Mcclellan Oscillator of the NYSE. Now we're looking at the Nasdaq Mcclellan Oscillator, which again is an oscillator that basically assesses the advanced decline line. It takes the 19-day exponential moving average of advancing stocks minus declining stocks, and then subtracts that from the 39-day exponential moving average of advancers versus decliners. The Mcclellan Oscillator, or NAMO. This is for the Nasdaq Mcclellan Oscillator. So again, while the Nasdaq itself has been consolidating, right? Here's the Nasdaq at the bottom. You can see that the Mcclellan Oscillator, it made its low here. So advancers versus decliners, but it has been trending higher ever since. Extremely choppy, folks, since July. But it has been trending higher ever since, while the Nasdaq has been going nowhere. Beneath the surface, breadth has been improving while the Nasdaq has just been consolidating for time. Things have been getting better underneath the surface of the Nasdaq. remember, this is from just last week's State of the Market. We looked at the percentage of new 21-day lows rising in the Nasdaq. We've been correcting. Percentage of new 63-day lows, 3 months. Going back to July here, folks, in the NAMO. We've been correcting in the Nasdaq 100. This is the Nasdaq Composite. Remember this, percent of stocks down 10% or more from their 52-week high. Not going in the right direction. Percent of stocks down 20% or more from their 52-week high in the Nasdaq. Not going in there's more stocks that kept going, 20% off their 50. Like, we've had pretty substantial corrections here, pretty substantial breadth weakness. But lately, look at where we are on the NYMO. Things were already troughing beneath the surface of the NASDAQ. Here's the NASDAQ Composite again. Only 8.7% of NASDAQ stocks have made 52-week highs over the past 2 weeks. This study is from today. You only have 8.7, less than 10% of the NASDAQ has made a 52-week high over the past 2 weeks. So if you look at all of the studies that we've seen in the NASDAQ here, discussed in the NASDAQ, studies and breadth, what do we need to kind of put all the puzzle pieces together? Like, if things have been getting better beneath the surface, if we have troughed in the NASDAQ, the next thing we want to see is this turn up. We want to see more new highs. We need to see more NASDAQ stocks making new highs, not new lows. Not new lows. We can't see that. We need to see this one curl up and improve. So we got a big rally underway today, right? Well, let's go check out and see what we got going on the NASDAQ new highs versus new lows. Here's the NASDAQ, new highs, new lows, 96 new highs versus only 48 new lows. Look at the NYSE, 147 new highs, only 20 new lows. We are seeing what we should be seeing, again, putting all the pieces together, suggesting the NASDAQ probably has bottomed technically. Again, fundamentals can really disrupt patterns, but technically, the NASDAQ should have bottomed on Monday or Tuesday this week. It should have put in its bottom because of all of the work we see that has already taken place. And now we're seeing a lot more new highs, almost double the new lows today on the NASDAQ. So we'll check this out again next week to see if indeed this curls up. It's just Thursday. We still have tomorrow. Anything can happen tomorrow, right? Okay, NASDAQ 100. Since we're going into earnings season, I think Netflix, is going to report next week even. The 20th, I want to say. NASDAQ 100 big tech earnings are soaring. Right? They just go higher and higher, right? But the PE multiple has been pressured throughout the year. This is the PE ratio of the big tech stocks going down while their earnings are going. That's been the story all year long, folks. All year long. This is actually typical of cycle transition. It's always temporary and always led to price explosion thereafter for the tech names. So do keep that in mind. And we keep hearing, no matter what tech is doing, no matter what FanMag is doing, we keep hearing that big tech and or FanMag are too expensive still. This really doesn't make sense. This is the chart. Big tech stocks, premium, meaning, are they trading at a premium to the S&P 500? Big tech stocks premium to the S&P 500 is the narrowest it's been since 2018. Here it was in 2018. Here it is today. The premium is right back to where it was in 2000. How can it be too expensive still? Yeah, it was too expensive here. Yeah, it's too expensive here. It's too, not now, like stop it. People need to, it's like people just get used to saying the same thing over and over and again. Well, I heard it on CNBC. I heard it on Bloomberg. It must be true. It is not. It is not. All right, but what about Facebook and Apple, right? Like we've had negative headlines on Apple, a Bloomberg article that basically disclosed, and I believe it's more than likely a truth, but they basically disclosed that Apple is going to cut its production by probably 10 million iPhone units. Now, Apple didn't announce this, but more than likely they are going to confirm it to one degree or another on their conference call when they report in a couple of weeks. Apple reports on the 28th. And what about Facebook, right? Because do I need to? I mean, all the negative publicity, the whistleblower, you know, Facebook seems to be in the spotlight every 6 months or so for something that well, quite frankly, the media outrages about. All right, well, let's first start with all the port issues and the supply line issues, because in speaking about Apple's potential production cut, it does stem from issues with chip supply and other fabricated materials. So again, this goes back to the whole supply line issues, the ports being congested, which is also manufacturing a degree of inflation. So if we review where we are in the whole port congestion issue and prices per 40-foot container that we've been reviewing and analyzing last few weeks, indeed, the World Container Index has continued to move lower here for now 4 weeks in a row. The composite index decreased 2.3%. Drewry is the global World Container Index. This is it. The link is here also, folks, so you can use it, check on it week in and week out, see if prices are still going down. The one that's going up is New York to Rotterdam, up 3%, but more than likely that's hitting its peak and is gonna roll over eventually. So the average composite index of the WCI assessed by Drewry for year to date is 7,126 per 40-foot container, which is higher than the 5-year average. But again, this is still rolling over, and almost all of the destinations are down. They're up year over year, down on the weekly change. And it's tough. I mean, look at the annual changes here, 565% from Shanghai to Rotterdam. Again, like, things don't grow to the sky. Lumber prices couldn't grow to the sky. Maybe trees do, but lumber prices don't. So there's your link. Check it out on a weekly basis. One of the things I always consider is the fever pitch. When things get just to a fever pitch level, when any subject matter around the markets or the economy gets to a fever pitch level, it's probably peaking. And I would be of the opinion that given all the attention, all the media highlights, all of the hyperbole, all of the pundits' commentary about inflation, about the supply lines, about the chip shortage, we're probably peaking. This is a Google search for supply chain issues. I mean, really, is it going to go off the charts? Barron's cover, The Economist cover, their magazines. And so what happens, like, all these problems are solvable. That's the thing about media commentary. They lead you to believe as though these issues are permanent. They're unable to be resolved. What we know about any issue is that it's human ingenuity. We always solve these problems. I mean, think about the COVID vaccine and how quickly, and we might have an antiviral pill in the next month, 2 months. We're going to have more than likely a vaccine for children under the age of 12 within the next several weeks. Like human ingenuity will solve these problems. And they've already started to, some of these issues have already started to bubble up to the degree that finally we do have greater participation to solve these problems. There's now going to be 24/7 operations at the Port of LA, Los Angeles, and Long Beach. They're going to run 24/7. Every other country, every other port in the world runs 24/7 except for the US ports. It's a bit archaic. I know why, but the reason why it has to at this point is because containers cannot sit in yards. The ports are not set up as storage facilities. They're set up as way stations, pass-throughs. That's it, port of entry, and then it's got to get out of there. Why? Because it's a grid system. Everything is on a grid in there. And it's all time slotted. So let's say you have a container coming from China to the Port of LA. You have to already have your bill of lading already rendered to the port officials. There has to be a dispatch for logistics out, your container out of that port within XYZ amount of time. And so on their dashboard, if you will, the whole port's dashboard, that square footage where your container, your 40-foot container is, it will flag in the system as vacant or occupied. And if it goes over the time allowance, well, guess what? And if there's no way to remove it, that's why ports are not supposed to be storage facilities. Ports cannot operate this way, and why we are at the place that we are, where you now have to run 24/7 operations. And you have Walmart, Amazon, Target aiding in the freight operations with their logistics providers. The National Guard is on call for potential deployment if the situation doesn't get remedied within the next 30 days. We talked about that. I said I wouldn't be surprised if the National Guard isn't stationed to help alleviate the port congestion issues. Now, one great thing that's happened is the China port congestion has already come way down, like 50% off of its high congested level. And part of the reason why their port was so congested is because of they have Golden Week, which is a national holiday. And so now that they're back in operation, it's already come way down. Again, the link right here, you can check it out for yourself, folks. So what is this all leading to with regards to Apple, right? And the global chip issues, just a whole context and the whole subject matter relates to supply lines. And that's why Apple is probably going to confirm some degree of production cut for the Q4 period. But read the fine print. Read the fine print. Back in July, Bloomberg's News, Debbie Wu and Mark Gurman reported that Apple had ordered as many as 90 million of the new iPhones from its contract manufacturers. That would have been 20% above the 75 million units that it typically ordered in previous years. So even if you drop it 10 million, from 90 down to 80 million, you're still above the 75 million that Apple typically orders. You see what? So it could be a production cut, but they're still going to have enough supply. There's going to have enough supply. It just might be wait times. You might have wait times. Apple usually orders far more devices than it expects it will need, giving it some wiggle room. If more people want iPhones than expected, it has the capacity, but it can reduce the size of its orders if that doesn't happen, and often does so. Conversely, it has a buffer should there be supply impediments, as Bloomberg Opinions Tycom wrote in July. So Apple's probably still going to see year-over-year increase in its iPhone sales. The production cut is, in my opinion, a matter of expenses and margins. They're going to still have, if it's just a 10 million unit cut for production, they're going to have more than its typical 75 million. That might also be what investors have come to realize. The stock is trading higher than where this news publication originally came out. This was yesterday. All right. The holiday season as a whole, don't forget, folks, yeah, we've had the CPI data, this week's economic data. The PPI data came in lighter than expected. Don't get me wrong. The CPI and PPI are still running at very elevated levels. There's going to be margin issues. There is. But all of the action underneath the surface of the market might have told us that, well, they priced it in already. And the fact that we're already seeing some signs of reacceleration out of the September economic period into October, I'd say the last 2 weeks, we've seen a pickup in all manners of things that were COVID, impediments, like service and hospitality, air travel, restaurant, dining, open tables. I mean, their reservations have just skyrocketed over the last 2 weeks. I'd be of the opinion we're reaccelerating. This morning, we got a fantastic jobless claims number, dropped below 300,000 in initial claims for the first time in the post-pandemic period, and now down 2 weeks in a row. This is helpful to the Federal Reserve when it comes to their tapering initiatives, which I do believe that they will announce next week. There were hints of it in the Fed minutes that were released just yesterday. And it looks like what they'll be doing is reducing the amount of assets that they'll be purchasing by about 15 billion a month. So they're usually purchasing about 80 billion worth of mortgage-backed securities as well as treasury tips, if you will. So they'll reduce it from 80 to 65 billion. Again, that's just per the Fed minutes notes from the last meeting. That can change between today and the November 2nd FOMC meeting. Could be a little more, maybe it'll be a little less. But today's jobless claims number goes a long way, not to just helping the Fed's cause when it comes to making further substantial progress on the labor and employment front, because they've already done it when it comes to the inflation front. But when it comes to labor and employment, we've had some really dicey non-farm payroll prints. But a dip below 300,000 in initial jobless claims, and you also had continuing claims move lower, suggests that the next non-farm payroll report should be pretty good, barring a disruption in the jobless claims trend. What that all leads to is just paychecks. More people are going back to work. More people going back to work, there are more paychecks, and that means there's going to be more dollars flowing through the economy, greater retail sales. And that's what we're looking forward to in the fourth quarter. All right, what about Facebook? We talked about Apple. So those retail sales dollars are going to Apple. They're going to Amazon. We know that. What would it take for advertisers to leave Facebook, right? Because you hear this constantly on CNBC. Well, I think this time is the time that the advertisers are going to leave. It's very doubtful. This was produced by eMarketer. All of these notes here from eMarketer. And here's some of their commentary. Some of the advertisers eMarketer spoke with have indicated that they're diversifying into different channels in order to ensure that they aren't overly dependent on the Facebook ecosystem. I think there is something to be said for the CPM, or cost per thousand, increases. It's much more expensive than it was last year. There's no question there, said Avi Benzi, Vice President of Paid Social. But rising CPMs, rising cost per thousand viewers, basically, only account for a fraction of his increased Facebook spend year over year. He said he's seen a major increase in investment for mid-funnel consideration campaigns on Facebook that are designed to fuel the bottom of the funnel. Let's see, that's my... Performance marketers like mobile app advertisers, for example, use Facebook predominantly to drive app installs, facing aggressive revenue targets and typically operating under the radar as brands those companies are less likely to take part in advertiser initiatives like brand safety boycotts, meaning they're going to stay with them. Brand safety boycotts, that's more likely to happen among bigger institutional brands such as Coke, Nike, Procter & Gamble, which have more of a stake in how consumers perceive their brand. These highly visible brands are often looking for brand exposure, which allows them to shift spending to other channels since the top of the funnel offers more advertising options. Now, here's what the analysts from eMarketer have to say. Facebook has weathered multiple scandals and headwinds in the past and continue to grow, indicating that advertisers will continue to spend on Facebook despite negative public perception. What's different this time is that Facebook is facing a real potential threat to its ad business. Here's another comment. Brand safety is a noble concern and something that many major companies think seriously about. But when it comes to their ad expenditures, the bottom line often ends up being more important. If ad performance were to start suffering, advertisers will look to other media. But brand safety concerns alone aren't going to drive most advertisers away. I agree. Where else are you going to find 2.8 billion eyeballs? It doesn't exist. And until, and we're not seeing any mass exit on the Facebook platform from users either. So if the users are still there, if they're still engaged, the advertisers are going to be there. I mean, Cambridge Analytica was awful. This is no better, this current whistleblower situation. But the ad revenue dollars are actually expected to go higher for the quarter and into the end of the year, more than likely beyond. This is another one of those situations where the media takes hold, of a headline, and they just run with it for days on end. But it doesn't affect the user engagement on the platform. Until it does, Facebook is where the advertisers are going to stay. So in the context of Facebook, why we're talking about Facebook, why we're talking about Apple, it's because these are two of the most heavily weighted stocks in the S&P 500 and the Nasdaq. They're about to report earnings. These are some of those fundamentals that we need to consider as we go through the earnings season. So with that, I'm Seth Golden. This is Finom Group's weekly State of the Market. Everybody trade safely. Until next week.